From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello and welcome to the COB on this Friday as we wrap up what has been a very tumultuous week, as it turns out, given off the back of what we heard from the Fed yesterday. And that selling has continued, as you can see, in the CBO 200. I can tell you it's down 1.3% or pretty close to it. A similar amount there for the ASX 200, which is almost close to 1.4% lower. And in fact, having lost almost 3% over this week. So significant pain felt. Mind you, many seeing that the markets maybe had run just a little too hard. And then, of course, we're talking about the Santa rally. Well, is that going to eventuate? Well, still a couple of days to go, I guess, see whether Santa does, in fact, arrive. Let's take a look at the themes for today. Freefall Friday, maybe that's overstating it a little. We saw that yesterday, as I mentioned, overall, shares having lost about 3% cumulatively over the past 2 days. Led by the banks having busted today. Of course, they've been outperformers with the likes of a CBA tumbling by about 3% today. And debt deadline. Again, we're at that time of year where the US confronts its debt issues with negotiations in Congress and throw in Donald Trump. And of course, we have a very confusing picture. We'll unpack that in just a moment. Let's take a look at the sectors at the moment, see how they're performing, particularly in terms of the retailers. In fact, Wesfarmers is under pressure today, despite having offloaded a business unit. It's down well over 3.5% at the moment. Red across the board. Lavisa also being hit quite hard. I mentioned the banks there, led by CBA, which is off 3.5% at this point. So tipping back to $150, in fact, and the other big banks following suit. The utilities, a quick look at that. They're perhaps one of the green spots, in fact, more positive there, what we're seeing among the utilities. Let's catch up with the top stories of the day. And Evolution CFO Barry van der Merwe will leave the company to pursue another opportunity in the industry or remain in the role until March next year. Integral Diagnostics shares, they've risen after the company announced it had completed a merger with Capital Health. Ventia Services rose after it announced a 5-year deal with Telstra. And Wesfarmers falling after it has sold Coregas for $770 million. And elsewhere, Cleanaway reaffirming its guidance of between $395 and $425 million for 2025 after announcing a joint venture with LMS Energy to process and monetize landfill gas. Well, it is that time of the week. Let's welcome Shane Oliver from AMP. Shane, a very good Friday to you as we get closer and closer to Christmas. And I was talking about the Santa Claus rally. Where's that gone in the wake of what we heard from the Fed?
Well, that's a good question. There's the problem with the Santa rally is that it's never guaranteed. Just looking over the last 15 years, roughly speaking, in the US and Australia, there were 5 years where there wasn't really a Santa rally. And I'm referring to the period from mid-December, so we were already well into that, out to the end of December. So that's normally the Santa rally period. But there are 5 of the last 15 years that didn't see a Santa rally and the markets actually fell. It's also quite possible, of course, that it may still come as we get closer to Christmas and go through the New Year period. Alternatively, you can make an argument that maybe we saw it going through November. Things were so strong in November, record highs in our market, many global markets, the same thing, including the US. So maybe we've seen it, and that left the market somewhat overvalued, overloved and overbought, and therefore they're vulnerable right now. And of course, I think Jerome Powell put paid to some degree to Santa when he announced that hawkish tilt yesterday or a day or so ago. So all of those things have combined to sort of weigh against markets. I tend to think there might be a bit of an overreaction to the Fed's change in tone. Perhaps just as there was a year ago when they tilted dovish. There was the so-called pivot to dovish. And then, of course, we went through a period going into April where they pivoted back to somewhat hawkish. So we could see the same swings again. I tend to think that the way the business surveys are going, inflation is going, wages growth is cooling, that you will see further falls in US inflation, enabling the Fed to cut again, and probably by more than 2 times as we go through the next year. But for now, investors are feeling a bit nervous, could still see a little bit more downside. But in the great scheme of things, I tend to think it is getting a bit overdone.
Well, and you mentioned perhaps those rich valuations and that many were looking for an opportunity to sell, and that was it, from given what they heard from the Fed. Well, I mean, goodness, maybe Santa was disguised as Donald Trump, given we had that Trump trade earlier on as off the back of the election. So just a little deeper into what we heard from the Fed then, Shane, given how the US economy is travelling, did those dot plots align with what you're seeing?
Well, I expected that the Fed would wind the dot plot back a bit because they were foreshadowing 4 cuts through next year. I thought they would wind that back to maybe 3. As it's turned out, they wound it back by more. They've only got 2 cuts coming in. So you can see the massive change on that chart there from what the Fed was suggesting regarding rates next year and the year after. That's now the green line, whereas back in September they had the blue line. And of course, that's all pushed the market expectation line up as well. So it has surprised me a little bit on the hawkish side. I kind of wonder whether the Fed was thinking, well, we've got Donald Trump coming along. We don't know what his policies will be precisely, but we do worry a little bit that they might cause inflation. So maybe let's get that out of the way, factor that in, rather than wait till next year. So that could have been a factor behind the Fed as well. But yeah, it did surprise me a little bit, the extent of the move, and also that the language, the shift in language was somewhat more hawkish as well. But I think they were still on track for cuts. If you look around the world, the last couple of weeks we've seen Canada, Europe, UK was on hold last night, but they're sounding a bit dovish. We saw the Swedish central banks cut again. New Zealand, I think, will possibly have to cut 75 basis points next time they meet, which is not till February. So we are seeing this ongoing drip feed of central banks cutting rates. The only ones that may not be are the ones that are already close to the bottom. So I think that's still the direction of travel for interest rates globally, i.e. down.
And Shane, further complicating matters in the US is the threat of another government shutdown. Now, we seem to be at this time every year. However, you throw Donald Trump into the mix and it's just got a little more complicated.
That's right. I mean, these shutdowns, debt ceilings issues in the US get a bit tedious after a while. I think as an economist, I've been through so many of these that you sort of think they must have a better way of doing things. But anyway, here we are. If they don't agree a funding resolution by Friday night, then the US government will shut down this weekend. And of course, they need to raise the debt ceiling on January the 1st. Of course, the US Treasury can survive for a few months thereafter. But we are coming into a potentially messy period. And of course, what this is showing, I think, is the odd situation we're in. It was an agreement had been reached between the Republicans in the House and the Democrats to increase funding for the government, keep the government open for the next 3 months. And then, of course, Elon Musk got hold of it and thought, this is crazy. And he then influenced things, and Trump jumped on it as well. So it sort of begs the question, is Elon Musk going to drive things going forward, which is a bit of a scary proposition. The other aspect is that the agreement that Trump then came to with the House has now been rejected. You've got a bunch of Republicans who didn't vote for it, which tells us that some Republicans aren't fully on board with Trump's policy and may present some problems for him as we go through next year. We know there is a conservative group of Republicans, I think the Freedom Caucus they call themselves, who are very much opposed to these bigger budget deficits. So it's going to be interesting to see how all this unfolds. I tend to think that any shutdown will be very brief. We know from history they don't have a lasting impact. They're quite minor, although everyone talks about it. The bigger issue is the debt ceiling and whether they're able to get that through. But it's when you throw all this into the mix, you can sort of understand why markets have suddenly got a bit nervous again.
Absolutely. Now, Shane, just before you go, I'd love to get your view on the Aussie dollar, given, pretty much currencies around the world under pressure, given where the US dollar has gone with the prospect perhaps of fewer US rate cuts. Do you see further pressure on the Aussie, and what are the implications?
There could well be further pressure. We were thinking up until Trump that the trend in the Aussie was up 70 cents. Now I'm kind of thinking, well, that's probably not the case. We're stuck somewhere between 60 cents, so we could have more downside to 60. just bear in mind, I think we got to about 58 at the time of the pandemic, so we're still above that, but we could still have a bit more downside. The record low for the Aussie was 48 cents, and I think that was back at the time of the tech wreck all those years ago, more than 2 decades ago. So we are still above previous lows. Several things to note about it. One, it's really a strong US dollar story. The US dollar has gone up against most things. So yes, we've come down against the US dollar, but we haven't come down against other currencies. So the so-called trade-weighted index, which is key for the Reserve Bank, has held up a lot better. And that would be what they would focus on in terms of whether this is going to cause a pickup in inflation here. So I don't think from an economic policy point of view, the Reserve Bank would be too concerned about it at these levels, simply because, yes, we're down, but we're in the range we've been in for a while. And secondly, we haven't fallen as much against these other currencies, i.e. the trade-weighted index is still relatively stable. So, but it is all down to the US, and the US dollar has gone up. So that's why we've gone down.
Shane, great we can get the wrap from you, as we have pretty much for every Friday this year. Terrific to have you on board. Have a terrific Christmas at the same time. Okay. And we look forward to speaking with you in the new year.
That's good, Andrew. You have a good one too.
Thanks very much. Watching. Let's now take a look at our stock of the day, which was Wesfarmers, off the back of its having sold its Coregas business. Here's the view from Luke Winchester from Merewether Capital and Daniel Teasey from Stock Doctor.
Look, I think at the moment, 20, 25, even to 30% fall, would bring it back into a more, I guess, normalised valuation purely from a multiple perspective. So we can see how much the stock prices, arguably can have to fall. Analysts are kind of suggesting that CBA looks 50% overvalued, just as an example. So, I think it's probably a bit steeper than what most people would expect.
I think for now, that valuation, it's very steep, 32 times earnings, and they're growing at 2-3% a year. Nice and steady, but a bit too rich for me. At best, I'll call it a hold, but I probably agree with Daniel. If it's one that's crept up to a high weighting in someone's portfolio, I think this is one you could look to trim and maybe either redeploy back into Wesfarmers if it continues to pull back, or look for other interesting opportunities in the market.
Okay, so let's check where we're at after the close now as a wrap up this week of trading, which, as I mentioned, has been tumultuous. So let's take a look at the winners and losers. And Codan, HMC Capital leading the list there. Ventia off the back of that deal with Telstra, Karoon and Weebit actually bucking the trend among the tech stocks. On the negative side, those goldies continue to come under pressure, led by Bellevue Gold. EVT and Seek also down, along with Wesfarmers and Bendigo and Adelaide. And a quick look at what is ahead next week. And locally, at least, we get the minutes from the RBA's December meeting, read on some home values from CoreLogic, and importantly, CPI for November, as well as retail trade. And in terms of what's seeing overseas, a real focus on jobs data out of the States, as well as a glimpse of manufacturing and services. That is the COB with a final check of the market down 1.35%, which is about a 3% fall over the past 2 days. That is the COB. Thanks for joining us. Thanks for watching and listening. We'll talk to you again next week.